When is it the best time to sell Bitcoin? Some people say it's never good to sell Bitcoin, right? Bitcoin over the long term tends to appreciate, so why ever sell the hardest of the monies? Bitcoin advocates like Michael Saylor even go into debt to buy Bitcoin. They're not looking at prices, they simply just continue accumulating and with leverage. But the question is it okay for you to temporarily, over the course of 1 year, to drop by more than 80%? That's what happened in 2018. Or to drop by 75%. That's what happened in 2021, 2022. Is that volatility okay? I think this question can be answered with two perspectives. First of all, there's the personal finance perspective, right? When you've got only a very small net worth relative to your income, maybe you only have 1 or 2 months of net worth relative to your income, then you can endure these kind of drops, because when Bitcoin falls that much, you can simply just buy the bottom again with your income. Now, once your net worth is in the billions, and it doesn't really make that much more difference if you've got 2 billion, 3 billion or 500 million, then of course you can again go very much risk on. So there is a personal finance question to be answered here. But besides that perspective, I think it is also possible to time Bitcoin somewhat. Yes, people say that nobody knows the future, and this is true, but there are probabilities. It is possible to see when things are cheap or when things are not cheap. Now, what we see over here might be somewhat overwhelming. This is a hodl wave chart. This is a long-term Bitcoin chart here in black, and the colors that we see in the background, they show how much percent of all of Bitcoin is held by different wallet cohorts, as in how much of Bitcoin has not moved for over 10 years, how much of all of Bitcoin has not moved for over 7 years, etc. We can see how active the Bitcoin supply is. And so of course people like Michael Saylor in the end help to shrink the liquid supply, and they help to create those higher highs and higher lows over time, right? This is one of the reasons why Bitcoin appreciates over time. And we can see that more and more of Bitcoin is held by the Michael Saylors of this world. Roughly 30% of all of Bitcoin has not moved in the last 5 years. Now, some of those people are simply long-term holders, others might be people that lost their Bitcoin. But in aggregate, Bitcoin becomes less and less liquid, more and more Bitcoin gets stored away, relatively speaking, despite the mining. And when there's an asset that gets more and more rare over time and that is seen as a store of value, it tends to appreciate. Now, the big advantage of Bitcoin relative to all other asset classes is that the transactions are 100% transparent. So when you buy property or when you buy stocks, etc., you don't know how long has the stock been held or who is currently buying or selling the stock. Or maybe for houses, is actually the comparables that you're using, are they valid? But for Bitcoin, we have all of that data. And with that data, I believe if we dive deep enough, we can get a market edge. We can buy low and we can sell high on average. Because once we add the wallets that hold Bitcoin for 3 to 5 years, so not just up to 5 years, but between 3 to 5 years, suddenly we see some volatility in that wave. So up to 5 years of holding, there's simply just people like Michael Saylor that hold over the cycles, that don't care about those 80 or 70% drops. But once you add the wallets that hold Bitcoin for 3 to 5 years, we do see sometimes corrections. Those kind of wallets tend to sometimes sell. And this might be personal finance related reasons, it might be views on the macro. Now, how do those cycles develop? Why do we sometimes see 80 and 70% crashes? I believe it's because of the adoption cycle. Over the very long term, Bitcoin appreciates because it becomes more and more rare, and fiat tends to expand in supply over time. So over the very long term, we see Bitcoin's price going up. But whenever Bitcoin reaches new all-time highs, this generates a lot of attention, right? When Bitcoin hits 100K, everybody wants to know about Bitcoin again. People search for Bitcoin and people wonder, should I actually buy Bitcoin? And so during times of elevated prices, new people enter the space, they buy some of the Bitcoin and they buy it from the people that bought Bitcoin early, right? So the early investors, they rebalance their portfolios. They don't want to have 90% of their net worth in Bitcoin because Bitcoin rallied that much, right? They might sell some Bitcoin and they might buy gold, they might buy stocks, they might buy a down payment on a house. The new entrants buy Bitcoin in the hope that the current rally continues for a long time. The issue is that at some point those new entrants dry up, right? There isn't enough people that can push the price higher. And so most people actually lose when they try to speculate with Bitcoin short term. So what we see over here is the percent of Bitcoin supply that has moved at least in the last 6 months. So this is the short-term supply, the supply that's more or less in the active traders' hands. And this tends to peak whenever the price peaks as well. Again, the long-term holders sell to the new entrants. Once there aren't that many more new entrants anymore, then the bear market starts, then we see those 80% corrections. We see it time and time again, the short-term holders tend to enter at high prices and the long-term holders cash out. We can also see again through this chart that more and more of the supply is held by longer-term holders. So those peaks tend to be at lower levels percentage-wise. Currently we are at a similar level to half a year ago, where Bitcoin was at 67K and then made a retracement of roughly 20%. And so the intuitive way, right, to buy Bitcoin when everybody is bullish about it, when everybody talks about it, that's the wrong way to ride the waves. Most people do this wrongly. You can only outperform buying and holding Bitcoin if you're better than the average, right? When you buy Bitcoin when most people don't want to have it, and when you sell when most people are excited about it. But is there maybe a statistical approach, an approach that worked pretty well in the past that we can use for trading Bitcoin? Here is my personal approach. Introducing the holy grail, introducing moving averages. Now I've actually refined the moving average strategy. I'll come to this in a second. So this strategy actually historically works. This is a Bitcoin long-term chart, and what we see in white is a moving average. So this is the 200-day moving average. And the idea is that we want to buy Bitcoin whenever the price is above the moving average, and we want to sell Bitcoin whenever the price is below the moving average. So we take a rally like this, right, a 425% rally, but we avoid bear markets like this when the price goes down by 58%. So when you backtest this, when you run a simulation of buying and selling Bitcoin based on those kinds of rules, you tend to outperform just buying and holding Bitcoin. So this does work. There is a bit of a problem though. First, whenever we buy in, we tend to be quite late, right? This was the Corona crash, and you went up by 68% before actually buying back in. And then the same thing happens for selling, right? We first see a crash of 37% before we actually sell. So this is a lagging indicator. We tend to not be the earliest to buy or the earliest to sell. And so the obvious solution would then be, why don't we shorten the moving average duration? Why don't we shorten it to say 170 or 150 days, or maybe 120 days, or maybe just 100 days, right? Why don't we shorten this further and further? Because then we would buy in much earlier, right? After a rally of 64%, but especially here, we'd sell after we've only corrected by 23%. Isn't this better? And the answer is yes and no, because there is an optimum to be found. Let's say we want to buy in even earlier, right? Let's say for this COVID crash here, we want to buy in already over here, and we want to sell already over here. Why don't we shorten the moving average duration even further, so that in the end this moving average gets really, really close to the price, and we see something like this. We're selling over here, we are buying back in over here. Isn't this way more attractive compared to the 200-day moving average, compared to something like this? And so here is where we run into a potential problem, because the shorter the moving average duration is, yes, the earlier we react to trend changes, but the more bad signals we get as well. Because let's run this to the extreme. Let's take the 10-day moving average. What happens now? We get a lot of buy and sell signals, and we end up buying over here, right? At the end of the day, we end up buying high, and then we sell low again over here. So we're losing 3% over here. The same is true the next day, right? We would be selling over here to then afterwards buy back in for a higher price, for 4% higher. So the shorter the duration of the moving average, the more of those bad signals we get, where we buy high and sell low, and we sell low and we buy high. And so the moving average duration has to be the exact right length that it triggers a signal when there's actually a momentum shift. Not buying and selling just at the end of the day, but also within the day would even generate more of those failed signals, right? There's a lot of wicks that simply just temporarily go above and below the moving average. This also creates a lot of trading fees. And so what's then really the best way to time the market? It's obviously not to buy when everybody is hyped, right? When there's a lot of long-term holders that are selling and when it's the short-term holders that buy. It is to do the exact opposite. And so what kind of moving average can we take? Is the 100-day the best? Is the 200-day the best? Is the 50-day the best? What historically at least worked the best? And how consistent are the results if we follow a strategy like this? Let me show you the result of 199 backtests. So this is a spreadsheet that starts in August of 2017 when Bitcoin was already somewhat developed. It was not just a few cents. Centralized exchanges were already around. And it goes until July of this year. I recently also ran the newest numbers. The results are the same. I've run the simulations of buying and selling Bitcoin based on those moving averages all the way from the 2-day moving average up to the 200-day moving average. And I have included trading fees in this simulation, 0.2% per swap. And we're doing two things here. We are buying whenever the price is above the moving average, but we are also betting on falling prices whenever the price is below the moving average. So we also make money when the price is below the moving average. We're betting on falling prices during periods like this. We are not just in cash. During the time period, buying and holding would have given us 28% per annum. When we trade according to the moving averages, we get different returns. Now, instead of looking at this in table form, we can also plot this. And this, I believe, is a much nicer representation to look at the results. What we've got here on the x-axis is the duration of the moving average. So this goes from 2 days all the way to 200 days. What we've got on the y-axis is the annualized performance. So per annum, the geometric average, what would we have gotten? Now, buying and holding as a reference point is here in black. So what this tells us is that the best moving average is the 120-day moving average. What it also tells us is if we go too short on the moving average duration, that all of the trading fees will eat us up. We are not going to make money by trading too actively. Trends tend to establish after 1 month roughly. And if we are not reactive enough, if we take the 200-day moving average, right? If we wait until we have crashed and if we wait until we've rallied a lot before we buy in, then we simply tend to get just buying and holding performance. So the best to avoid the failed signals, but to still be very reactive is the 120-day SMA. Now, how well did this work? It's 127% per annum versus only 28% per annum. This is how that looks like over time. So in white is the Bitcoin price during the time, and in purple is the backtested result. We start the simulation with $10,000, and over the course of 6 years, this grew to an 18x to $180,000. Now this is a linear chart, so we can't really see what happened in the early days. When we look at this on a logarithmic chart, we see how constant the performance is. So let's do that. Here's the exact same performance, but on a logarithmic chart. Again, we see Bitcoin in white. What we see over here is the miner capitulation. This is the COVID crash. This is the recent 75% drop. And again, we don't yet see the rally to 100K, but the result is pretty much the same. And just have a look at how much nicer the appreciation is when we use the 120-day SMA. The drops are much smaller, right? We do not go down by 70% temporarily. We appreciate very, very nicely. And we also outperform buying and holding a lot. Now, this is a back test, right? And nobody can guarantee that the 120-day simple moving average will work better in the future. However, what I really like about this back test, about the result of this back test, is that pretty much any of the moving averages in that duration, right? Between say 110 days and 140 days, pretty much all of them outperform buying and holding massively. So it's actually not that important what moving average you take. If you take the 50-day, you still do more than double of buying and holding. What I like about this result is that the approach in general works. This is just fine-tuning what worked really the best, but the approach in general works if you don't overtrade, if you don't just have, say, a 10-day moving average, if you don't take too many failed signals, if you've got somewhat of a reasonable duration, you tend to do better by following the trends compared to just buying and holding. And so this is what we should look at, the 120-day simple moving average. That's how that looks like on a chart. And this is not the first time I'm talking about this. I'm talking about this since the beginning of this channel. And I have bought in over here. I've talked about this with the premium members of this channel as well, right? This is down below, thebitcoinstrader.com. This is where I share whatever I currently do with crypto, and where I can also learn how to do those kind of backtests, where we've also done backtests for all kinds of different altcoins. But yeah, this is where we are currently at, right? We are in a bull market. We should still continue to hold Bitcoin, but there is some risk. We would still be bullish even if we were to drop, say, to 77K. So a drop to 77K would still be a buying opportunity. If we were to drop to only 70K, so another 7K lower, then we would be below the moving average, and then it would be time to sell. So the idea is not necessarily to find the best exit and the best entry opportunity. The idea is simply to ride the overall macro waves. It is somewhat of an active approach, but it doesn't require to check the price every single day, because it's very unlikely that we're going to hit the moving average tomorrow, right? We are simply in a very smooth bullish trend. And so really there are several approaches to this. If you're okay with going 70-80% down with your Bitcoin value, if you're even okay to lever this up, then feel free to simply just do the same as Michael Saylor. If you only have 1 or 2 months of net worth, I don't think that's a problem. If you've got $5 or $6 billion, it's also not a problem. If you've got 20 years of net worth relative to your income, it is a problem, right? I would not be 100% in Bitcoin, again, because you don't want to fall from 20 years to 4 years and then lose your financial independence. But besides the personal finance aspect, I believe there is a way to beat the market. I believe that the crypto market is not that mature that trends don't matter anymore. The results are simply too convincing. This approach works with pretty much any parameter. So it works across permutations. It also works very consistently over time. I don't believe that the results are random. I don't believe that this is overfitting the data. The results are simply too consistent, both across time, but also across the different parameters. Now, the 120-day simple moving average is not the only approach that I use. It's a very useful approach, but there's also other useful approaches that dive deeper into the on-chain analytics. I publish videos on those approaches regularly over here as well, so feel free to subscribe. Feel free to also give this video a like in case you got some value here. Now, one more thing. If your net worth is already in the 2 to 3 years of income and above, then I do believe it's hyper important to figure out how to properly grow that wealth. If you are over allocated to Bitcoin, or if you're over allocated to stocks, if you don't have the right balancing, and if you're not riding the waves properly, if you don't look at opportunity costs the right way, then you're leaving out a lot of potential wealth for the future. And so especially for those cases, for cases like yours, it's very important to be up to speed, because those kind of things do not get taught in school. There's more than 100 tutorial videos in the premium membership. The link is down below. It's currently $165 per month. There's also a 1-week money back guarantee. So in case you don't learn enough, in case you don't get enough value out of premium, just message me within the first week and I'll refund you 100%. Feel free to check it out risk-free. See you in the next video, or see you in premium. Cheers.